Typically, there are two types of life insurance, and dying too soon is a major challenge, so we need to make sure that we're protecting our families properly. First example is something called whole life or permanent insurance. It's comprised of three components. Number one is you pay a monthly premium. Let's call this $100 per month. And this premium goes to two areas. Area number one is actually the cost of insurance. In this sample, we're going to use $25 per month. That will purchase $100,000 of life insurance. That's called your coverage amount. The other $75 per month of the 100 is going to go to a savings component called cash surrender value. So let's say after 20 years of paying $100 a month to this insurance company, your savings component has $11,000 in the account. Now there's a couple of funny rules when it comes to this cash surrender value. The first is if you actually need to use this money while you have this policy in force. So option number one is you borrow this money. It's called a policy loan. Typically, you would borrow your own money, this $11,000, for 6 to 8%. Your money is going to the cost of insurance and the savings. So essentially, when you draw this out from the insurance company, you're drawing out your own money, but it's not called a draw, it's not called a withdrawal, it's not called a redemption. You're actually borrowing at 6 to 8%. If you don't like that option, no sweat. They've got a great other option. You can cancel your life insurance. So if your family does not want the $100,000 if you die, no problem. If your family does need the $100,000 when you die, this canceling of the insurance is not an option. So really, your option is, number one, is to borrow your own money. The third funny rule is, let's say you pass away. The savings component, upon death, you actually do not have your family get this money. So this really is called an OR program. Upon death, your family gets this, or prior to death, you borrow this, or cancel this. You never get both the coverage and the savings in a whole life or a cash value policy. What makes sense is to separate them. We call this buy term and invest the difference. Let me give you an example. We take that same $100 illustration and we take $25 per month and we buy pure term life insurance. That's our coverage. We purchase $100,000 with a separate policy. Now we open up an investment. This is called the invest the difference. The difference is $75 per month. We were spending $100, we still are. It's split. $25 a month to the insurance company, $75 a month to an investment firm. So these two are not tied together like down here are. Let's say after 20 years, same illustration down here, instead of $11,000, if we were to earn a 6% in a well-balanced, professionally managed portfolio, we would have approximately $34,000. If in between 0 and 20 years you required to use this money, instead of borrowing, you redeem it. The other option is, instead of canceling the insurance, this insurance has nothing to do with this investment. So essentially, if you pass away after 20 years, your family would receive the $100,000 plus and the $34,000. If you keep the insurance coverage and you need to draw from this, it does not affect this. So essentially, this is a horrible program and most people don't realize it. Buy term, invest the difference, and you'll always be safe.